All right. Good afternoon, and thank you for joining us today. My name is Natalie Wolf, and I'm the Director of Investments at Foundation for the Carolinas. And on behalf of the executive leadership team at FFTC, we thank you all for joining us today. If at any time during the webinar you have questions or would like further clarification on any specific topic, we invite you to post your questions in the Q&A window. The Mercer team will address these after the presentation during the Q&A portion of the webinar. If we do not get to your question during the session, we will follow up with you after the webinar. This webinar is being recorded and the link will be added to the fftc.org website. You could access it by going to menu and the link is under Engage, Events and Webinars, or feel free to also email me. I will now introduce Travis Pruitt and Tim Westrich, who lead our consulting relationship at Mercer. Travis will be leading the discussion and will address market conditions and investment performance for FFTC's investment pools as of the latest quarter. So I'll hand it to you, Travis.
Great, thanks, Natalie. Welcome, everyone. I hope everyone is having a great summer, not melting, as most of the country appears to be. I will give you a recap of where we sit for the quarter. I'll give you some sense of what we're thinking for the future, and then Tim and I will be, of course, available to answer any questions. So with that, let's get rolling. So it's at the top line. It's been a pretty darn good year for equity markets, particularly. We've seen global equities go up a little better than 6% through the first 6 months, for the second quarter of 2023. And that has resulted from a continuation of market leadership we saw develop in the first quarter, primarily amongst these US large cap growth or US growth companies. We're going to go into more detail on what's driving those underlying bits in a minute, but we have seen across the growth spectrum, both large and small, we've seen leadership come from growthier names, companies that have a little bit more speculative feel, or that are perhaps have more aggressive expected growth rates.
Hey, Travis.
Yeah.
I do not see your screen.
Can you not? Tim, can you see it?
I cannot either now. If you need me to.
Let me pause, and I'm going to stop share and I'm going to try it again. Share. Can you see it now?
There we go.
Oh, there we go.
All right. Apologies. Not sure what happened there.
Okay.
We are seeing leadership across the cap structure in terms of growth, but the strongest leadership is coming up from the largest cap stocks. What that's resulted in with the quarterly results is we have seen global stocks now up nearly 14% for the first 6 months of the year. Again, led by the over 28% return from the US growth indices market-wise. Some other interesting notes I didn't circle here. US small cap stocks essentially generated their entire positive year-to-date return in June. For the first 5 months of the year, small cap stocks waved to and fro, but essentially we're flat to the end of May. But now through the end of June, we're up through June, or in June, we're up 8%. So interesting market dynamics being played out today. Also, developed market stocks, pretty competitive with everything except for those US growth securities, up double digits year to date as well. And then emerging markets have been a bit slower this year, primarily on the back of slower reopening within China coming out of their COVID lockdown. So equity markets in general, even outside of the market leading parts, seem to be discounting in growth overall and potential growth of earnings in the markets. But this divergence either suggests investors have grown more speculative appetites, or there's concern that we will have a slowdown in the economy and they're remaining focused on growth stocks. Not exactly sure which of those that is, but the market definitely is pricing in, or seemingly pricing in, one of those two particular outcomes. If we look down the page, and look at that year-to-date outcomes for real assets, we start to see investors in those marketplaces do seem to be pricing in some kind of aggregate demand slowdown, primarily in the form of the price of oil. So in the first 6 months through June, the price of oil was down about 12%, and that is reflected here both in the commodity number and the natural resource number. That's bounced back a bit, actually quite a bit here in July, but volatility has been the story of the day. Up and down, actual up and down volatility has been the story of the day in this part of the marketplace, as with, say, small cap, as I noted before. But there is still some concern being expressed in this part of the marketplace around the potential for an economic slowdown. We see that a little bit as well in the fixed income markets. We did see rates tick back up a bit in the quarter. The Fed did take a pause. It is Fed day, so we'll see where they're going to go after today. But we have seen rates come off their highest levels from 2022, hence the year-to-date positive return. Interesting, while there's a bit more caution in the fixed income markets, or in the core investment grade fixed income markets, in places like high yield and leveraged loans, which are higher credit risk and more highly levered structures, there actually continues to be quite a bit of interest in that part of the marketplace. And you can see both a really pretty good quarter as well as a pretty good year to date. So there are some cross currents being priced into marketplaces that I think reinforce the comments I made from the first quarter, which is we do continue to expect volatility to be the norm, and economically and perhaps it's hard to say market wise, but certainly economically, we do think there's still a reasonable chance that we could see a slowdown into the back half of this year and into early next year. I promised a bit more detail on this narrowness of market leadership, and so we have a number of slides we built together for this. I went with just this one. There's this pretty meaningful dispersion this year between the mega cap stocks, the top 5 names in the S&P 500, and the other 495 names. And so you can see here through, we updated this data, we produced this in mid-June. Story will be much the same through the end of the month. The top 5 names were up about 47% collectively through the nearly the first 6 months of the year. And you can see the bottom 495 names were only up 7.5%. So that S&P return of about 15% through mid-June really dominated by the biggest cap names. And in fact, if you look even further, I opened a second chart just to give you some numbers. You expand that list out to the top 7 names. Almost 80% of the S&P return through mid-June was generated by the top 7 stocks in the S&P 500, meaning that the other 20% or so were generated by 493. So it's been a very tight marketplace. That is generally not a great time for active management, and we have certainly experienced that, which we'll get into in a minute. But it's a pretty meaningful driver in terms of market returns this year. That's not uncommon. When we look back at 2020, when we're coming out of the pandemic bottoms, the big names, the higher growth, higher expected growth companies drove overall market returns, with the top 5 generating returns over 50%, well in excess of those smaller names. As we look at 2021, a bit more similarity in the dispersion. And then 2022, as rates started to go up, we saw valuations correct in those biggest names. And we actually saw the top 5 underperform by a pretty fair amount versus the bottom 495. And 2022, interestingly enough, was a pretty good year for active management. So if we think about what contributors are to this recent outperformance, particularly this calendar year, then certainly there's been this investor sentiment around artificial intelligence, or AI. Each of these companies, particularly Google, Facebook, Microsoft, and if you extend to the top 7, stocks like NVIDIA have really been driven by the release of ChatGPT to the general public, and this all of a sudden feels almost gold rushy move to implement artificial intelligence. And we're seeing it across the ecosystem, from providers of the service, developers of the service, to seeing how big companies are starting to engage and consider integrating AI tools into their businesses. If it's a place of great promise, both from a development as well as a user standpoint, we're interested to see how that shakes out. Many are calling this the next wave, but that has definitely contributed to the growth rates in some of these stocks. The Federal Reserve did pause, and it appears they've changed their stance in terms of how they're going to address the notion of further rate hikes. they are meeting today. I think that the consensus is that there will be another quarter-point rate hike. It's hard to say with absolute clarity, but seems reasonable that they would raise rates today based on rhetoric that's come out of the Fed over the last several weeks. But there's going to be around this notion of Federal Reserve will be probably more volatility and less certainty around what the Fed's going to do versus say most of 2022. And as a result of that, we think that leads to probably intra-period volatility similar to what we have seen. And then, amongst some of these tech companies, and you're seeing it really across the tech landscape, technology companies perhaps overhired. And as a result, there have been pretty meaningful layoffs within the tech sector, which theoretically would right-size their business groups and allow them to generate even more free cash flow and better earnings over time. So perhaps another potential positive in the near term around these companies. There are really high expectations built into most of these stocks, and in particularly with the recovery that they've seen this year. So, to the extent that we see any of these notions bear off or other things that suggest could impact earnings growth or overall growth, the expectations built into these names could lead to volatility there at the top of the index moving forward. There's a lot of momentum, a lot of people interested in those names today, and fortunately, your portfolios get a fair amount of exposure, a lot of exposures to these portfolios, as S&P 500 index is our largest, probably single asset within most of the portfolios, certainly the long-term funds. So just some additional economic data, just reinforcing some of the comments I've made. The economy continues to hold on. GDP growth is hanging in there. Jobs growth or jobs, unemployment levels are hanging in there. The consumer continues to demonstrate they've got a lot of capacity to spend. I don't know if any of you have traveled recently, but I've had a chance to fly some in the last few weeks, and airports are full, airplanes are full. So it does not feel like we're in a recession, certainly. Does it feel like it's screaming? If you're traveling, it does, but maybe in other ways it doesn't. But while the economy here, particularly in this right-hand chart in the upper left-hand corner, 2020 forecast, we've seen economic growth expectations fall. Still, generally speaking, many investors are believing that it's going to hang up and not actually hit a full-out recession. But there are, continuing my theme of potential impacts to volatility, there are a divergence of opinions as to whether we're going to be in a recession, whether we're in a recession. I think it is less and less clear every day as the timing, potential magnitude, or even likelihood of reaching a full recessionary period. There just is a really interesting mix of good and average data in the marketplace. Inflation is one of those improving data points. Again, varying views on what's most important to the Fed. Because labor continues to hold on, the compensation wages continue to be perhaps above what the Fed would like to see them to be. As a result, that will be, and we would expect that to drive a fair amount of the rhetoric going forward. It is potential. So there is a probability that absent, these falling energy prices, given some of the demographics we see both in the U.S. and outside the U.S., that you could see inflation not get all the way back down to the Fed's target, but maybe find a new level to moderate while we deal with smaller workforces, greater demand for labor, and an aging baby boom population that moves closer and closer, if not already, into retirement. So that is a potential that could keep inflation greater over time and therefore contribute to this notion of keeping rates higher over time. As I mentioned, the bond market is taking a rather cautious view, and bond market participants continue to price in this notion of a recession with a meaningfully inverted yield curve. It's pretty flat once you get out to 5+ years, but in that front end of the curve, we do see that it's really pretty inverted. If we're not taking huge bets on the Treasury curves, as you know, we've been underweight fixed income duration. That is, we've owned lesser maturities than our benchmark for some time. That's helped pretty considerably over the whole course of the relationship, but certainly in 2022, that helped a lot. We continue to hold those positions and have no intermediate term plans to cut or trim those. Our most likely scenario in our view right now is that the yield curve gets back to normal shape by the short end coming down. But again, timing and magnitude of that still remains quite opaque in our view. And so we continue to hold those positions, taking a slightly less aggressive view for fixed income. So lots of moving parts and lots of things for us to consider in the management of the portfolios. And so as we transition to see just how things went for the quarter, the absolute returns mirrored in large part each of the subcategories of indices, with just one exception. But as I noted, active management in general was a pretty challenging quarter, particularly in the US, where those large cap names dominate. If there's an environment where we would expect to underperform, this would be it. A very narrow number of names driving results. Having diversified approaches to portfolio construction generally struggle to add value in those periods, at least from the standpoint of performance. So we did underperform for the quarter, and we are behind year to date in the US equity portfolio, in line for non-US equity, modestly behind in emerging markets for the quarter. The one place where we did have a greater challenge was global opportunities, which is only in the diversified long-term growth model. There are as primarily factor exposures underlying that portfolio, but it's experienced a fair amount of tracking error or difference from its benchmark. That is under full review currently, and we do expect to have some additional thoughts on that very, very soon, as it has worked against us here, whereas most everything else is much, much closer to benchmark. I talked about that. In terms of year-to-date performance, emerging markets equity had a really strong first quarter, and so being close to benchmark in the second quarter and what has been a tougher market has allowed us to generate some additional positive excess return there in emerging markets. And then, as I mentioned, I talked about the real assets performance in the marketplace. You can see the absolute results were pretty mixed across the board in our three liquid tools that we use here. The Lazard portfolio, which is actively managed, did continue to outperform and posted a very strong premium against its benchmark year to date. The other two parts are passive, but you can see that in these real asset components, you see much more of the pricing of potential slowdown, whether that be real estate, which is definitely impacted by the challenges in markets like office, as well as the natural resource index, which, as I mentioned, has a meaningful component to both oil as well as mining and minerals, so reflecting some pullback in those sectors. Our risk-reducing assets, absolute performance and relative performance, much better. The hedge fund portfolio, again, also used only in the diversified long-term growth portfolio, outperformed its fund-of-funds composite, and again, as an asset that we hold in lieu of more fixed income. If you just roll your eyes down the page, you can see that the 2.8% return for the quarter and the 5.5% for the year to date, quite competitive against the fixed income universes of which we own it. So in 2022, that was a really meaningful difference in performance to the positive for the hedge fund portfolio, and that continues this year as the interest rate environment continues to be a bit volatile. That being said, our fixed income managers both performing really pretty well. The fixed income portfolio, which has two underlying active managers, have benefited by their bias towards credit and other structured securities, and so generating about 0.5% of excess return for the quarter and about 80 basis points. And this portfolio is, for those of you in the income and growth model, this is about 40% of your assets in this particular fund. So it's nice to see those assets do well. And then, as I mentioned, we do own low duration, both as the single manager in the low duration standard pool, as well as 20% of the income and growth. And then it's about 20% of the fixed income exposure in the active longer term pools. We get good performance by Sterling and a nice hold up for those places where we benchmark it against the aggregate. And then cash actually has performed really pretty well this year as well. So translating that into standard pool performance, you can see those of you that own liquid reserves portfolio, the opportunity cost in cash is largely gone right now as the yield curve is inverted, which is giving us annualized cash rates close to 5% net of all fees. And so you can see getting about a little better than 2 for the first 6 months of the year. When we look at I just talked about low duration, and so you can see those numbers really mirror pretty well. Passive long-term growth. So our 75-25, basic stock bond index up nearly 10% for the first 6 months of the year, reflecting that diversified portfolio and that still strong equity returns. So in line with benchmark as we plan for it to be. I lost my active long-term growth circle, went away. Let's bring that back. There we go. Active long-term growth, which is also our, basically the same 75-25 format, but with a blend of active and passive strategies. As I mentioned, a little bit behind this quarter, based primarily on that U.S. equity underperformance, but within the ballpark, and that's continuation of the first quarter, which has caused our calendar year results to be behind. Again, if there's an environment where we think we might underperform, this would be it. Or maybe I say that an environment where we think there's a better probability that we'll underperform, this would be it. And I think we're within expectations on the portfolio. The ESG pool, on the other hand, because it has a bit more of a bias towards the growth style, we just find that to be more common within the ESG, the managers that have a higher degree of ESG integration. It has performed very well this both the quarter and on a year-to-date basis. The ESG pool basically in line with its benchmark for the second quarter, but a really nice performance on a calendar year-to-date basis. You'll recall if you're interested in the ESG pool, it did get out of the gate a little bit slow and underperform in 2022. Because we did see a shift of value and really some strong drivers from the oil and energy complex. As those have backed off this year, the ESG pool has been a bit more better positioned to benefit from that. And so you can see it is generating a better year-to-date return than perhaps some of our other strategies. And then finally, the diversified long-term growth portfolio, just as a reminder, it has a fair amount of non-public investments. So it's got a 15% allocation to hedge funds. It's 20+% allocation to private capital. So those things don't price every day. And as a result, some portion of the portfolio is not caught up, if you will, with the other items on the page, which are all daily priced securities. So if we looked at this longer, we looked at the longer term performance, you can see that the 1 year and longer term performance numbers are much more akin to what you would expect. But in an environment like this is where we would expect to, this strategy should take a little while to catch up, if you will, just from the standpoint of public market equities. So I've sprinted through 25 minutes of conversation. So I will pause there and maybe even stop sharing so we can see faces and take some questions.
Thanks, Travis. I will wait just a minute as I let people put their questions in the Q&A box. It is at the bottom. Press on the little bubble with the Q&A, and we will respond in the webinar. Wait for just a moment, and then I will see what comes in.
Okay.
All right, one question on underlying managers. So any particular or notable outperformance or underperformance of some of the underlying managers within the pools, and any comments around that?
Sure. So there's a couple of interesting, I don't think any outside of global opportunities, which I talked about a little bit already. And it is a unique set of exposures that don't look very much like the benchmark that we benchmark it against. And as a result, and some of those exposures, we have some dedicated China exposure in there. We have some European small cap exposure. We have some biotech exposure. Those, all of those, each of those managers we think can add value in their respective places over time, but they tend to have a fair amount of individual volatility. And none of them are in a leadership position in the current market environment. And so when you add those factors together, that's contributed to underperformance more recently in Global Opportunities. Not so much in that case any specific manager issues. Within the U.S. equity portfolio, as I mentioned, it's about 75% in S&P 500 passive, which we continue to believe is the right place to get our large cap exposure within that pool. But we pair with that about 15% of the portfolio between Aristotle and a value contrarian small cap strategy, and similarly with GW&K and their core growth strategy. Both of those managers have participated but have trailed this year relative to their specific small cap index, and by extension, because small caps underperformed the broader market, the broader market index. We don't think through anything that they have done particularly wrong, but as managers that tend to own higher quality and or tend to not pursue the most speculative type names in a marketplace, we would expect them to underperform in this environment, and they have. We're continuing to underwrite both positions to make sure that we remain comfortable, but nothing out of line there. The other place in both the U.S. and non-U.S. portfolios that has been a bit more of a challenge in the year-to-date basis, but that added a lot of value in 2022, is we do have a lower volatility. We have lower volatility managers in both the U.S. and non-U.S. equity building blocks, and their objectives are to invest to take advantage of an anomaly in the marketplace related to the individual volatility of stocks. And stocks that have lower volatility as a factor have shown to have some persistence and outperformance over full market cycles. It gives us the opportunity. It gives us the ability to bring down the overall volatility of the individual pools, but it creates tracking error, if you will, creates differences versus benchmarks in short periods of time. Sometimes positive, like in 2022, when those positions really held up nicely, and sometimes negative in 2023 when the market is off to the races, led by a narrow group of stocks, but that leaves behind some of those other lower volatility areas. But those are probably I think we've gotten good execution through the rest of the portfolio. By and large, that, as I mentioned, the fixed income managers are doing great, and the hedge fund portfolio really performing and holding itself up. Tim, I don't know if there's any other notions you might add to that.
No, the only other things that I would just comment, and probably more general, is that because going back to, I think, the second or third slide of the presentation, because the market has been so concentrated, one thing we've seen across the board is that it's been a difficult environment for active management, particularly large cap growth managers, because of the concentration within some of the benchmarks where Apple's 13 and Microsoft is 11. So the change that we made a couple years ago, I guess going back 3 or 4 years, where the bulk of the U.S. equity LLC is now passive and S&P 500 exposure, was a good move, and that held up pretty well. So there is an underperformance there, where we do see that underperformance in a lot of other portfolios, a lot of actively managed strategies.
Okay, thanks, Tim.
That's a good point. Thank you. Question from me. You mentioned investor sentiment surrounding artificial intelligence, and again, to the narrow market and these top 7 stocks really taking off. Besides what we read, and everyone's talking about it now. What are you hearing from your clients and investors? We talk about investor sentiment. Everyone reads about investor sentiment, but I like to hear just anecdotally what other conversations you're having in your everyday.
So I think it's a mixed bag from investors, right? And like many new technologies, there are those that are slower to embrace and see the value of it, and some that are more engaging. So probably the best example, we just had an all company meeting yesterday, and as you know, we're part of a large public company, and we're, as a company, taking a proactive, positive view towards figuring out where artificial intelligence might help our business. Clearly not, just bring it in, turn it on, and walk away, because it's the technology is still a long way away from that. Hopefully, forever away from that for all of our jobs' sakes. But we're seeing an increasing number of organizations look for ways to take advantage of it and look for ways to leverage the advances made thus far to give, particularly, those of us in knowledge industries, to give us a really meaningful, I don't want to use a term that Microsoft has patented, but someone who does, a machine that can, basically a machine assistant that can really help you, whether it distill information or better communicate, or maybe help you better find data that you're looking for amongst your sea of data. All of us have massive amounts of data to parse and understand and evaluate today, and some of these tools really may be able to help organizations do a better job of that. There's, from a market perspective, there's an awful lot of positive expectations priced into some of these stocks that may or may not be achieved, right? And to the extent that these expectations aren't achieved, then some of those names could, that's when you see names come under a significant amount of selling pressure. So we have been asked, well, are you leaning into portfolios, or are you adding, dedicated growth, allocations or large cap growth allocations to participate in this? And we don't feel like we have any particular edge from a portfolio management that perspective. And those things tend to work until they don't. And so what I hope I'm not doing is in the fourth quarter call and in January of next year, still talking about a very narrow marketplace, but we very much could be if the current environment, current investment sentiment stays the way it is. And there's really, sentiment's an interesting thing, and that there's no switch that says, oh, we just turned it off and now people don't want out anymore. It just actually starts to show in data. And I think the small cap numbers for June are a good example of that, where the market was flat year to date at the end of May, and at the end of June it was up 8. And that's just very difficult to say is good fun. Something fundamentally changed in the 30-day period to change the outlook. And if you're betting on sentiment, that's just not a place. Very few people are good at that, and that's not a place where we feel like we have an edge. And so we're gonna, we're comfortable with our portfolio structure in trying to address and take advantage of things like AI.
Thanks. Let's see if there's any other questions. You mentioned the Fed is meeting in about 30 minutes, and it looks like the consensus is to raise rates 25 basis points. What would you bet on, that raise? Or
yeah, I'd probably bet on the raise. If you I might owe 24 people a cup of coffee.
Yeah, what should we bet?
Yeah, I took a look at the options market this morning, and it was pretty close to 100%. So if you would take the opposite side of that bet, you may end up owing.
Yeah, so I do think it's likely. I think, in my mind, I don't know that this is my personal view. I don't know that the number of raises being quote unquote left is the interesting notion here. It's the duration of keeping them where they are. I think that's the more important notion now, thinking out past just a quarter or two. I do think there's a risk that you could see inflation table at a level higher than the Fed is after. And as a result, the Fed showing discipline, I don't know if discipline's the right word, but certainly resolve and keeping rates higher for longer. Feels weird to say that, money market rates at 5 are high. Feels back to normal in some ways, but there's a meaningful cadre of the street and investors, worldwide, that believe that rates will come down, the first sign of trouble, and you'll see that in periodic bets in the marketplace and rallies in certain sectors. I think that is a lower probability event, and that rates likely stay higher for longer unless something just really massive breaks. I don't think in this case it's going to be the market that causes that. Have to be something economically, but that remains to be seen. And again, we don't necessarily have an edge. This is my personal view. We're not making portfolio position adjustments to try and leverage one way or the other on those. We're staying pretty close to target. We've held a little bit of cash just because there's less opportunity cost, gives us a little bit of flexibility to rebalance. But relative to our long-term targets, we're really pretty close. We just think the risks are pretty balanced in this environment.
Sounds good. One last question for you, as I've been getting more questions around our ESG pool. What do you wish people would ask about ESG, or how to think about ESG investing really outside of what the media headlines say and in politics? What does it mean to you? What does it mean to Mercer? And what does it mean in our pool? And why is it important to even discuss this, whether it be on nonprofit boards or among, in a donor advised fund?
Sure. So I'll try and take a as far away from political view as I can on this. As a firm, we've been integrating ESG evaluation of manager strategies for a very long time. And I mentioned before, we're part of a large global public company. We have a very large investment business in Europe. And in Europe, ESG matters a lot. And so as a result, we've had to do the work of that, to think about how should ESG fit into the investment management business? What factors are very important, because we have to. You can take a view as to whether we have to from a environmental or social perspective. I won't say that you have to, but I do think that our view is that it's another set of risk factors. And you can argue whether or not you believe in global warming, but clearly the last several years have shown some change in environment, some change in weather patterns and extremeness of weather. And whether that is directly human related or not, it certainly has economic impacts. Ask the folks in Vermont that won't be able to get flood insurance, perhaps going forward. Or, I read just an interesting story this morning in the Journal about having to change crop types in southern Italy because there's not enough rain and they can't grow rice anymore, for example. So those are risk factors that we think are important to take into consideration when you're evaluating a company and the business that it does, or where it does business. And you don't have to express a view as to whether you think global warming is a thing or not. You just have to, by integrating more ESG notions, more consideration about environmental impacts into the way that a company does business or where they choose to do business will be important to understanding the risk factors to those companies moving forward. You don't have to be ex-fossil fuels to be an ESG investor. And in fact, in your ESG pool, you are not. There are some strategies that won't own fossil fuels, but it's not by any means a full prohibitive exclusion. We're probably a long way from being able to step fully away from fossil fuels, but we want to be exposed to the companies that are doing a good job there, both a good job of generating earnings and a good job of being stewards of their capital and their environment, as well as those companies that are investing heavily and trying to get to the next phase, the transition to new things. So that ESG, I said a lot of things, and I think probably the big takeaway there is ESG means a lot of things to a lot of people, which can make it difficult for folks to decide whether an ESG option works for them. What we're attempting to do within your ESG pool is make sure that we're invested with managers that are taking it into consideration in their investment strategy, whether it be through really a primary focus of investing in areas of strong ESG good. So the US passive strategy is like that. One of the two global manager strategies is really focused on that, where they're really focused on good returns and good outcomes. And fortunately, both of those strategies actually perform really pretty well this year. When certainly that comes up often as can ESG perform? We think that it can. But other parts of the portfolio just take that, maybe they take more governance or better stewardship of their businesses into account. Maybe they strive for diversity of thought and seeing that as a value to their business and a risk reduction to have a broader range of experiences to weigh in on the decision making for the company. Or maybe it speaks to the millennial generation, particularly my youngest. All three of my kids are millennials, but my youngest is very much into understanding these kinds of things in the way that he will invest and think about being a consumer going forward. So all those notions are good risk factors we think to consider for performance evaluation. And like any other active approach, there'll be periods when it will work and there will be periods when it doesn't. And so we saw ESG not perform particularly well in 2022, but the ESG pool has bounced back really pretty nicely as the environment has changed. So I think it's, you know, like any other active factor, something to take into consideration, understand what it is you find attractive from an ESG perspective, perhaps, you know, what's the good you want to do, and then we'll be happy to talk through how the ESG pool helps you do that and what it seeks to achieve and what it doesn't.
Well, thank you. That's a great answer. Well, thank you both, Travis and Tim, for being here with us today and sharing your insights on the markets and performance. And thank you to all our participants. We hope you found the webinar informational. And just a reminder, we'll be posting a recording of this webinar to my FFTC/resources as soon as possible. Thank you all, and hope the rest of your week goes very well.
Thanks, everybody. Take care.